Let's discuss real estate. You've worked your whole life, you've paid down your debt, and now you are sitting there in your 50s wondering if it's too late to build serious wealth through real estate. Here's the truth nobody talks about enough. Your 50s might actually be the single best decade to accelerate your investment journey. You have something that younger investors desperately wish they had, and that's financial clarity, life experience, and in many cases, freed up cash flow from finally getting rid of those monthly debt obligations. Today we're going to walk through exactly how you can take that momentum and channel it into real estate income that starts working for you right now. I actually got my real estate license twice during my life, but had the worst possible timing with it. The first time was in order to work as a mortgage lender. Guess what happened a few months after I got hired on with a mortgage firm? You guessed it, the 2008 housing crisis. The second time was during the pandemic. Awesome. Okay, let's change the channel back. So this video is not about real estate theory. It's about the specific steps you can take this week, this month, and over the next few years to build a real estate income stream that could genuinely change what your retirement looks like. Whether that means buying physical properties or using real estate investment trusts, you have real options available to you right now. So let's get into it. First, let's talk about where you actually are. If you've spent the last several years aggressively paying down debt, whether that was credit cards, auto loans, or a personal loan, you have just done something incredibly powerful. You have created breathing room in your monthly budget. That freed up cash flow is your launching pad. Most people in their 30s and 40s who want to invest in real estate are fighting against monthly obligations that eat their potential capital alive. If you're here watching this video, you don't have that problem anymore. If you still have credit card debt, please watch my video on how to pay that down as fast as possible. The link is in the description below. The question isn't whether you have the resources to start. The question is, which vehicle is going to give you the best return on the time and money you have available? So let's look at your two primary paths. Physical real estate is the first one. Real estate investment trusts, or REITs, is the second. Both are legitimate. Both have produced real wealth for real people. And both can work simultaneously, which we will get to later. Starting with physical rental properties, one of the most important things to understand when evaluating any rental property is whether the numbers actually make sense before you spend a single day visiting houses or talking to agents. There are a couple of quick screening tools that experienced investors use to filter deals fast. The first is something called the 1% test. Here's how it works. You take the monthly rent a property would generate and divide it by the purchase price. If that number comes out to 1% or higher, the property has a reasonable chance of producing positive cash flow. If it falls well below that threshold, you are likely looking at a deal that will cost you money every month rather than generate it. This isn't a perfect rule, but it is a quick filter that saves you from wasting time on properties that will probably never work as rentals. The second tool is the 50% guideline. On average, about half a rental property's gross rent goes toward operating expenses. That means property taxes, insurance, maintenance, vacancy, and property management fees if you use that. Notice that doesn't include your mortgage payment, so if a property rents for $2,000 a month, you should expect roughly $1,000 to cover expenses, leaving you $1,000 from which to pay your mortgage. If your mortgage payment is less than that remaining amount, you have positive cash flow. If it's more, you do not. Running this quick mental math on any property you are considering will tell you almost immediately whether it is worth a closer look. A question I hear constantly from people starting in their 50s is this: do I really have enough time to build a real estate portfolio? And my answer is yes, but your strategy needs to fit your situation. You're not necessarily going to want a house hack, which is a strategy where you buy a small multi-unit property, live in one unit, and rent out the others. That approach is powerful for younger investors who are more flexible about moving every year, but it might not be realistic or desirable for where you are in life. What does make a lot of sense for someone in your position is a more straightforward acquisition strategy, using the income and savings you have built up. Here's what a realistic, accelerated plan looks like. If you've been eliminating debt and are now freeing up, let's say, $1,200 to $1,500 a month that was previously going toward debt payments, That's $14,000 to $18,000 a year in new savings capacity. Over just 2 to 3 years of disciplined saving combined with whatever nest egg you may already have, you could be looking at enough for a down payment on a solid income-producing rental property in a mid-priced market. Markets in the Midwest and parts of the South still have single-family homes and small multifamily properties available at prices where the numbers can work. Your goal should be to purchase one property every 1 to 2 years and hold it for the long term. You do not need to build a 10 or 20 property empire. 3 well-chosen cash-flowing rentals can generate meaningful supplemental retirement income. Now here's a critical step that too many beginning investors skip. Before you buy anything, get very clear on your numbers. What monthly cash flow do you need to meaningfully supplement your retirement income? Work backward from that goal. If you want $2,000 a month in passive rental income, and each property nets $400 to $500 after all expenses and mortgage, you are looking at needing 4 to 5 properties. If you want $1,000 a month, 2 solid rentals might get you there. Knowing your target gives you a roadmap. Let's talk about the second path, and this one is fantastic for people in our position who want real estate exposure without the management headaches. Real estate investment trusts are companies that own portfolios of income-producing real estate, ranging from apartment buildings and office parks to hospitals and self-storage facilities. You buy shares of a REIT the same way you would buy a share of stock, through any brokerage account. And here is what makes REITs incredibly compelling for someone looking to generate income quickly. By law, REITs are required to distribute at least 90% of their taxable income to shareholders as dividends. That means you are getting paid regularly, typically every quarter, just for holding shares. The average equity REIT, meaning one that owns actual properties rather than mortgages, pays a dividend yield of around 5%. Compare that to the average yield of dividend stocks like Johnson & Johnson or McDonald's, around 2%, and you can see why income-focused investors pay close attention to REITs. Some specialized REITs pay even higher yields, though higher yield often comes with higher sector-specific risk, so understanding what you own matters. Now here's a tax consideration that's especially relevant if you're in your 50s and building toward retirement. REIT dividends are typically taxed as ordinary income rather than the lower qualified dividend rate. That could mean a tax bite of anywhere from 24 to 37%, depending on your bracket. However, if you hold your REIT investments inside a tax-advantaged account, like a traditional IRA or a Roth IRA, you can either defer or completely eliminate that tax burden. If you've been contributing to retirement accounts over the years and have room to maximize contributions, or even open a self-directed IRA, housing your REIT investments there is a smart move that protects more of your income. For people who don't want to research individual REITs, there is a simpler option. REIT exchange-traded funds pool together dozens or even hundreds of different real estate companies into one investment. This gives you built-in diversification and eliminates the risk of putting too much weight on one sector. If one type of real estate struggles, say retail or hospitality, during an economic downturn, other sectors within the fund can offset those losses. This kind of stability is exactly what you want when you are building income for retirement, rather than swinging for speculative gains. So what does an actionable starting plan actually look like for someone in their 50s who has cleaned up their debt and is ready to build? Here are your steps. Step 1. Sit down this week and calculate exactly how much monthly cash flow you have freed up from your debt payoff. That number is the foundation of your investment capacity. Step 2. Open or fund a tax-advantaged account if you have not already. Maximize your contributions and direct a portion specifically toward REITETFS to start generating dividend income now. This gets you into real estate immediately without waiting to save a full down payment. Step 3. Spend the next 6 months learning your target real estate market. Pick one geographic area, ideally somewhere within a few hours of where you live, or a strong rental market you can research thoroughly, and start tracking property values, rental rates, and inventory. Step 4. Apply the 1% test and 50% guideline to every property you look at. Do not fall in love with a property before the numbers confirm it makes sense. Step 5. Use the income generated from your REIT dividends to supplement your down payment savings. You are essentially using one real estate investment to fund your path toward physical real estate ownership. Remember, I'm just a guy on YouTube. Make sure you do your own research and make decisions that make sense for your own life. I'm simply trying to help open your mind to the possibilities that are out there. Here's the bottom line. Starting in your 50s is not a disadvantage. The debt you eliminated gave you firepower. The life experience you carry helps you make better decisions. REITs give you immediate income while you build toward physical property ownership. And physical rentals, even one or two well-chosen ones, can provide the kind of consistent monthly income that makes retirement feel secure rather than stressful. The people who regret starting late are the ones who waited even longer because they assumed it was too late. Do not be that person. Your next chapter starts right now. I hope you got a ton of value out of this video, and if you did, please watch my comprehensive guide to financial freedom starting from nothing video, which you can click on right here. Also, please consider liking and subscribing, and drop your own thoughts and ideas in the comments. My name is Flint, and I will see you in the next video.